As part two of our financial principles and budgeting class this week, financial analysis, I wanted to take a look at financial statements real quick with you. There's three main financial statements a senior living provider operator looks at. That's the income statement, the cash flow statement, and the balance sheet. The income and the cash flow statement record events and show events that happen over a period of time that could be a month or a quarter or a year. The balance sheet always records the financial condition of a company at a point in time. It cannot reflect a series of events. It's just a point in time snapshot of assets and liabilities. In addition, financial statements, the income statement is typically has a month to date and a year to date column. It is very important to look at and report on variances over the actual results of the operation versus what we budgeted for. Those can be expressed in many different ways. For example, over or under budget in negative and positive numbers. Some senior living providers prefer the favorable, unfavorable verbiage. There's reporting by department, for example, for the maintenance or the dining department. And variances can also be expressed in a percentage versus the nominal number. Here on this slide we see a sample income statement for our MAS 406506 sample community for April 2010. You see the revenue section. This should look familiar to some extent. I kind of mixed it up here a little bit and created a mix of independent living, assisted living, CCRC, financial. You see the monthly fees in the revenue section as well as vacancies, which is oftentimes used in assisted living, other revenues, and entrance fee amortization, which only would come into play for a CCRC or another similar type of entrance fee model. So you see the actual column with the recorded number for the period, for the stated period, which is April 2010. The monthly fees are $95,000. However, we budgeted, that's the column right next to it, $97,000 for a negative variance of $2,000. Some operators will say we are under budget in monthly fee revenue. Other senior living providers would express it as this is a $2,000 unfavorable variance to the budget. On the far right hand corner here we have year-to-date information on actual budget and variance. This gives us a good idea of not only how the month is doing but how we're faring year-to-date for the entire fiscal year. And for example, on the total revenues we can see that the monthly fees are not just off for the month of April, but we're in a negative territory, negative variance territory for the entire fiscal year, which means it's more of a trend and not just an occurrence in this month. The expenses, we have administration, marketing, dining, maintenance activities, and so forth. One thing I want to point out is that entrance fee amortization on the revenues and depreciation on the expenses are non-cash items. So we don't actually receive money and we don't actually spend money. The depreciation is based on a depreciation schedule of the building and physical assets. The entrance fee amortization in the revenue section is based on the amortized entrance fees that we receive from residents when they move in over either their projected lifespan or the lifespan of the building. Revenues over expenses give us a net operating profit or loss. In this case, our operating profit is $17,580. And then below that bottom line we have investment or finance activities, investment income, and also interest expense on the loans we have outstanding for a total net income loss of $17,180. So besides the income statement, we also have the balance sheet. This is the asset section of the balance sheet with current assets, property, plant, equipment, replacement reserves, and so forth for total assets. Then we have the liability section of the balance sheet as well that records short-term, all current liabilities, and long-term liabilities for total liabilities and net assets. In this case, the net asset number is negative, which means we have more liabilities than assets outstanding, and the total number, according to generally accepted accounting principles, have to be matching. So the $7,296,041 have to be recorded on both assets and total liabilities and net assets. That has to match. Financial indicators, ratios, real quick, you can read that up in the textbook as well. It's explaining it fairly well. We have the operating margin, which measures the effectiveness of an operation. Here in this example, in our sample company, the net operating income is $17,580 over $112,500 operating revenues, so that gives us a margin of 15.63%. The operating ratio measures the efficiency of the operation. That means how much money do I spend for every dollar I get in. In this case, it's 84 cents, which is a very good ratio. Days cash on hand measures the liquidity of a company and of a senior living community. Here we have 220 days cash on hand, which is not quite what banks would look at, especially in the CCRC world. You will read the Wall Street Journal article in which is mentioned that banks look at typically 300 days plus cash on hand. The current ratio measures the liquidity of the operation, but also the ability to service short-term obligations. If the current ratio exceeds 5, that means that capital is not properly used, and if it's lower than a 2-to-1 ratio, then it typically shows that there's not enough liquidity to service short-term obligations, and you can read that up in the textbook as well. The debt service coverage ratio is a good indicator for the community's ability to service debt, and in this case it's a 1.28. That's the total net available to service the debt over the debt service. 1.28 is a very good number. Banks typically look at a 1.25. Cash to long-term debt ratio, or the reserve ratio, is the total cash divided by the total debt, and here the cash to debt is 0.16, which shows us that there's quite a bit of debt on a facility that has limited amounts of cash and shows a slight over leverage. In addition to the financial indicators, there's also the valuation of assets of senior living communities, and I wanted to speak to that a little bit because it was mentioned in the textbook, excuse me. The higher the capitalization rate is, the greater the investment risk is, and as you can see here in the summary, various senior living communities have different cap rates. As the levels of care and the intensity of care increases, so do cap rates as well. And cap rates have moved up in 2010 just due to the economic crisis and the lack of available capital. And here's a sample calculation of what a slight difference in cap rate can mean for the valuation of a project between a 6.5 and an 8.5 cap rate. The difference in valuation is over $4 million, $4.4 million in this case. So that is that for the financial discussions. If you have any questions, please post your question to the Ask the Instructor discussion board or send me an email to thhirsch@retirement.org as always. Thank you very much.